The S&P 500 hit its lowest close of the year today, signaling a significant technical breakdown. With geopolitical tensions mounting, the market is increasingly caught between these immediate macro risks and the potential for long-term structural growth driven by AI. Economic data is shifting toward a stagflation narrative. Financial Insight reports that U.S. fourth-quarter GDP was revised down to 0.7%, coming in well below previous expectations. At the same time, Brent crude has pushed above $100. This suggests the market is poorly positioned for an unexpected inflation shock triggered by energy prices. Global liquidity is currently contracting at a 4% annual rate. According to 42 Macro, this drain is being led by sharp tightening in Europe and Japan, leaving the broader market poorly positioned to handle an unexpected inflation shock triggered by rising energy prices. While the macro outlook remains cautious, 42 Macro identifies a hidden strength in U.S. productivity. By adjusting for recent government data distortions, they estimate that structural AI adoption is driving underlying growth closer to 3.8%. This suggests that long-term efficiency gains are building a buffer against shorter-term economic pressures. Moving to corporate strategy, Financial Insight reports that the FTC has approved a move allowing Tesla investors to gain indirect equity in SpaceX through an XAI conversion. This structure provides shareholders with exposure to high-value private assets, while the core automotive business faces headwinds. It highlights the divergence between short-term economic constraints and long-term industrial efficiency. The S&P 500's recent move lower is looking more mechanical than fundamental. Alpha Trends points out a pattern of lower highs and lower lows, with the index failing to break above its declining 5-day moving average. Nana reports this pressure is coming from systematic CTA selling, and they note that these flows don't appear to be fully exhausted yet. Systematic selling from CTAs continues to drive significant downward pressure. This mechanical weight is now visible in tech leadership, where Alpha Trends highlights a potential head and shoulders top in the semiconductor sector. With major leaders like NVIDIA being rejected at their 50-day moving averages, the market environment has fundamentally shifted away from a bullish dip-buying regime. Beyond technical selling, systemic risks are now surfacing in the private credit market. Danielle DiMartino Booth highlights a recent redemption gate at a Morgan Stanley fund as a significant warning sign. These gates trap retail capital and can force investors to liquidate their more liquid holdings just to raise cash. This cycle of forced selling creates a feedback loop that increases the risk of wider market contagion. Danielle DiMartino Booth argues the Federal Reserve is overlooking clear signs of economic cooling. She points to census data showing average payroll growth of just 70,000, a figure suggesting the labor market is significantly softer than headline reports indicate. According to Booth, this disconnect between restrictive policy and real-time data increases the risk of an engineered downturn if the Fed remains too tight for too long. Adobe shares fell 8% today, despite earnings that Sven Carlin describes as strong. He points out that at 13.6 times projected earnings, the valuation may be offering a floor. At the same time, Charles Schwab reports its advisory business grew 42% last year. This outpaced its retail growth as more clients shift toward fiduciary models. In the tech sector, Broadcom shares pulled back today, even as the company forecast triple-digit AI revenue growth, a clear example of structural gains battling short-term technical selling. Looking toward next week, Financial Insight is highlighting the NVIDIA GTC conference, where the new Rubin architecture is expected to feature significant performance gains. The market's technical structure has shifted away from the bullish dip-buying regime. For the week ahead, we're tracking 3 key areas. First is NVIDIA, with catalysts expected at the GTC conference starting March 16th. Second, we're watching Adobe to see if its valuation floor holds as analyst sell ratings rise. Finally, we're monitoring the private credit market for any new redemption gates that could signal broader liquidity stress. These cues will help clarify if this sell-off is a technical correction or a deeper macro shift. We're staying focused on high-signal data as macro headwinds and technical pressures build. Keep a close watch on the stagflation narrative, especially the widening gap between rising oil prices and stalling GDP data. You can find the full list of sources and citations in the description. Thanks for listening, and please subscribe for more data-driven recaps.